This would have been under the auspices of the multilateral system of the WTO, and started pushing more to what not myself, but other trade economists have called a power-based approach to trade negotiations. In other words, a much more bilateral approach, particularly with respect to China. And I think superficially, at least the way it's presented in the media, that shift to power-based bargaining, maybe it worked. And people point to the import commitments, both for agricultural imports and manufacturing imports from China, under the US-China trade agreement. It's actually called the US-China Phase 1 trade agreement, but that's a bit of a mouthful. So I'm going to call it the US-China trade agreement, or the USCTA for short. So superficially, it would seem to have worked, but it didn't avoid what Jennifer Hillman, she's a very well-known trade lawyer. She was originally appointed to the WTO Appellate Board under the Obama administration. I'm quoting here from her congressional testimony that she was very worried that any bilateral agreement wouldn't avoid a narrow deficit-focused bilateral deal. And I have to say, I think that the USCTA was rather narrow in that respect. And I had a paper published about 2 months ago in Applied Economic Perspectives and Policy, where I make the argument that essentially power-based bargaining, certainly with respect to China, has essentially failed. Because what we've done in the United States and also with China, we've pushed our average tariff levels towards what they were pre the formation of the General Agreement on Tariffs and Trade back in the 1940s. And this has gone a long way to undermining the multilateral system. And if you look at this graphic here, this is just the history from January 2018 through to early February 2020. The red line is the successive escalation of China's tariffs in retaliation to those of the US. And the blue line is the successive implementation of higher and higher tariffs by the United States against China. So that on average, the two countries, those trade-weighted tariffs are now around about 20%. If you go back to the Smoot-Hawley Tariff Act of the late 20s, early 30s, trade-weighted average tariffs for the United States were running at around about 29 to 30%. So we've pushed tariffs back towards almost just in the beginning of the post-war period, at least with respect to China. Secondly, and this is well documented, not by me, but by mainstream trade economists in various journals, that this power-based bargaining came at some cost to US consumers in terms of higher prices. It came at some cost to taxpayers, particularly the market facilitation program, where US farmers were compensated for their lost market share in China, and also has come at some cost to exporters. And I'm not going to spend time talking about that. But maybe the point I tried to make in this recently published paper, and I'm not the only person to have made this point, is that the agreement really failed to address issues relating to China's economic model and the weakness of the WTO disciplines on China's use of industrial subsidies. So what drove the United States to go to a power-based bargaining approach? Well, US concerns over China's trade policies are pretty widely documented. And here I cite the US Trade Representative's report in 2018, just before the trade war began. And this document, along with a number of other documents, USTR produces this report every year. And I've just read the most recent one. And the most recent one says pretty much the same thing as the 2018 one did. But it led to the US under the previous administration provoking what you might think of as a trade policy crisis. So why did it do this? Well, China, under the current leadership in China, is no longer transitioning to a market economy. And in particular, it's exhibiting an extensive use of explicit and implicit subsidies, particularly to state-owned enterprises. Secondly, the US for a long time has been very concerned about how ineffective WTO legal remedies are. In other words, the US has been pretty unsuccessful in using anti-dumping and countervailing duties against China. It really started using these pretty heavily after China joined the WTO in 2001, but they don't seem to have done the trick. Plus, the US has lost quite a few cases at the WTO in terms of use of these policies. That sort of leads into this third bullet point, is there's a tremendous amount of dissatisfaction in the United States trade policy circles with the WTO's appellate body. That's the sort of court of appeal at the WTO and some of its rulings. And one of its rulings, which the US perceives as being pretty pernicious, is that the way China works subsidies is to run them through state-owned enterprises, and then they claim they're not government subsidies. And the WTO actually agreed with China. And so this makes it very difficult for the US to target subsidies by given to Chinese firms that the Chinese would claim are not from the government. And finally, the lack of this, the WTO simply hasn't negotiated to develop new trade rules targeted at what a Yale trade lawyer has called China Incorporated. And I've talked about this in some of my previous presentations. So let's focus now on agricultural trade. What have been the concerns about the United States with respect to agricultural trade and China? Well, in the main, agriculture sort of got caught in the crossfire of the trade war. If you go and read that 2018 report, there's very little discussion of agricultural trade. But if you dig a little bit deeper, what the US essentially focused on was China's compliance or lack of compliance with the Uruguay Round Agreement on Agriculture's disciplines on agricultural policy and agricultural trade policies. So in particular, the United States has been concerned about market access into China, and here they focused on administration of tariff rate quotas. I'll talk a little bit about the wheat tariff rate quota at the end of my presentation. There's been a lot of discussion about the slow approval process or the opaque approval process for genetically modified crops being exported to China. And there's been a lot of discussion about phytosanitary technical barriers to trade measures. And the Chinese have been pretty good at using those to prevent US agricultural imports getting into China. Secondly, there's been a big focus on domestic support in China. It's kind of interesting that China has actually increased its spending levels on farm subsidies, but it's very non-transparent, the methodology that they're using to calculate the amount of support they're giving to their farmers. And then this is the third bullet is the third piece of the Uruguay Round disciplines on agricultural policies. You're supposed to report your agricultural subsidies to the WTO, and China has been very remiss but actually reporting these. It's not just China, lots of countries have failed to report their export subsidies to the WTO. So the United States has actually filed two separate complaints to the WTO in September and December 2016, respectively. One was targeted at China's domestic support for corn, rice, and wheat, and the second was targeted at China's administration of its TRQs for corn, rice, and wheat. And the WTO established investigative panels in 2017 for both of these issues, and they made rulings against China in each case in 2019. So what's really interesting here is that despite the US's overall shift to power-based bargaining, it's essentially, with respect to agriculture, in many ways has continued to abide by the WTO's dispute settlement process. And more recently, the US has sought authorization from the WTO to suspend concessions that it's made to China on the grounds that China's not in compliance with these panel rulings, and it did this in 2020-21. So my point here is that the US is continuing to engage in multilateral governance of agricultural trade at the same time as it's adopted bilateral bargaining with China through this thing called the US-China trade agreement. So we're kind of playing both sides of the trade negotiation game here, particularly with China. So where are we with the US-China trade agreement? Where did we end up? So this began in 2020 and formally was completed at the end of 2021. We're waiting to see if there's going to be a second round trade agreement. I had breakfast with my trade lawyer colleague over from the Moritz School of Law the other day for breakfast, and he said he thinks there might be a second phase one agreement, but I've tried to ask my friend who works for the United States Trade Representative's office, and she won't tell me anything. So anyway, US ag exports were pretty much a bright spot of that agreement. 83% of the target was met as of December 2021, but it was still short of the legal commitment. And Seung-Ki Lee, my colleague, talked about this a little bit in his own webinar, which was the last webinar we had a couple of weeks ago. So going through some of the key commodities, soybeans, which account for 60% of the value of covered agricultural exports to China, they actually went below target by about 36%. But other exports ran either close to or well above target. So corn, remarkably, was over 1,000% above target. Now, remember, we started from a very low base, but that's still a pretty significant overrun over target. Pork, 300% over target, wheat, 110% over target, and sorghum, 102% over target. So a key question that you might want to ask is, was this due to the trade agreement or other factors? Now, I would argue that the rebuilding of Chinese hog production capacity was pretty well key in driving the imports, particularly of animal feed, especially corn. I think that's why you saw that massive increase in corn exports to China over 2020 through to 2021, because we were exporting a lot of pork to replace Chinese pork production. Wheat was being sucked into Chinese animal feed, and sorghum was being used in Chinese animal feed. So here's a graphic. Seung-Ki showed a graph quite similar to this in his webinar. These are data from Chad Bown, who writes for the Peterson Institute of International Economics. This was his February final report on the agreement. So the dark line is shows you US agricultural exports to China from 2009 onwards. You can see that they peaked around about 2012, tailed off a little bit, tanked during the trade war, which began in 2018, and then really picked up as the trade agreement went into place. We ended up over that period exporting $61 billion worth of agricultural commodities, compared to the commitment of 73.9 billion. So we hit about 83% of that target. Interestingly, Chad Bown, and I don't really know how he did this, so you're going to have to take his word for it, because he doesn't really explain it in his presentation. He's actually a very highly regarded international economist who he was at, he's worked very widely for the World Bank and others. He did a little calculation where he shows actual exports by China. That's the dark line. And you can see that from 2016 onwards through to the end of 2021. The legal commitment, that's the red dotted line under the agreement. And then that sort of yellowy brown line, that's his forecast for what would have happened if there'd been no trade war. So you get rid of that big reduction in exports and no US trade US-China trade agreement. And what you can see is that the trade war probably did the most damage, as you might expect, to US agricultural exports to China. But pretty much his forecast tracks where we ended up actually with the agreement in place. So you can take that for what it's worth. So I think what he's saying is the commitment, the agreement didn't really get us that much relative to what otherwise would have happened. So let me talk a little bit about market access and what I'm going to call managed trade, which is a terminology that's creeping back into the language of international economics and trade policy. So the legal disciplines of what was called the GATT, and we now think of as the WTO, the focus of the WTO is on what we call tariff bindings. Those are the commitments by countries to lower their tariffs and then commit to not raising them unilaterally above those levels. So the rules of the WTO are very strict about maintaining those bindings. And there are also disciplines on countries' policies, such as these things that I've called tariff rate quotas. But there are also disciplines on export subsidies. There are disciplines on domestic farm policies. There are disciplines on intellectual property rights, yada, yada, yada. There are lots of disciplines within the WTO. But the US-China trade agreement has shifted to contracting not on transparent policy choices such as tariffs, but on market access. Now, clearly, cutting tariffs generates market access, but we're now switching through this bilateral managed trade based on power-based bargaining. We're going to contracting on market access, something that trade economists call managed trade. And what this requires is commitments by an importing country on the amounts of trade in terms of imports. But that doesn't solve the problem that shocks, either internal or external to China, can affect those trade volumes. In other words, how do you evaluate import performance? You can always evaluate whether a country is violating the WTO disciplines, but it's always very difficult to evaluate whether is China below its import commitments because it's failing to meet its commitments, or because there's some exogenous shock to that that's driving it. Also, if you have managed trade, what are the available remedies that can be applied to China if it's not actively meeting its bilateral import commitments? So let me then move to talking about, I seem to be I think I've lost a slide here, but no problem. So we can think of the invasion of Ukraine as a very extreme shock to the world economic system and to international trade in particular, which has a clear potential to undermining our ability to evaluate something like managed trade. And managed trade, you'd have to go back to the 1980s where we last saw the terminology managed trade. And this was vis our trade relations with Japan. And in those days, managed trade mostly related to getting the Japanese to voluntarily restrain their exports of automobiles to the United States. So instead of working on the import side with a country like China, we worked with the exporting country, Japan, to limit their exports. And this was called managed trade. So this Russian invasion of Ukraine, the economic shock has two very clear dimensions that I'm going to talk about. One is the impact of the financial sanctions against Russia. And, Brent, maybe there'll be some questions about this. I don't fully understand all the likely effects, but I'm going to give you my best shot in the next slide about where I think we're going with the financial sanctions. And then I'm going to talk about disruption to agricultural commodity markets and then tie it back to my argument that it's very difficult to evaluate managed trade if you have a really significant shock to global agricultural markets. So I'm going to argue that the prospects for agricultural exports in a world where the US is maybe continuing its approach of managed trade is going to depend very much on China's response to what's happening, and also the extent to which global supply and demand for agricultural commodities react to this disruption. This is not rocket science. This is demand and supply 101, as far as I can tell. So let me talk about financial sanctions first of all. So what are the key financial sanctions? Now, there are many things going on. I'm going to talk about the two that I think really matter, and I think it's the second one that is really the most important of the two. First of all, we've had the removal of select Russian banks from the SWIFT digital banking system, and essentially that's going to stop Russia buying imports, paying for its imports, and it's going to stop Russia being paid for its exports. Now, there's been some discussion of maybe Russia will switch to the Chinese version of SWIFT, but I've not seen any serious analysis of that yet. Secondly, and I think, and this is probably not a very good metaphor, this is the nuclear option that has been implemented. China's central bank cannot access its foreign currency reserves that are being held in foreign central banks and foreign banks. Russia has built up reserves, I think it's of around about $640 billion. You can think of that as a war chest, which it would be able to use to prop up its currency. So if you were to get a run on the ruble, what you would do is use those foreign currency reserves, say at the Fed, to buy up rubles in order to support your currency. It no longer has access to that. So this is a remarkable sanction, I think, that's been implemented by the United States and the European Union in particular. These are unprecedented sanctions. And Paul Krugman, in his column in the New York Times yesterday, described this as immiseration. And I had to remind myself of what immiseration meant. I see Brent laughing there. It actually means this is deliberate pushing of the Russian economy into economic poverty. It's a Marxist term, apparently. So I need to go and study what immiseration really means, but that's what he's arguing. It's these sanctions are shutting down the the Russian economy to the point that it's going to really reduce their standard of living. So we've observed a collapse in the ruble. Okay, that's from February the 28th. That doesn't even include the last couple of weeks. So that's showing you how many rubles to the dollar. And essentially what you're seeing is the US dollar gets you a lot more rubles, which if you flip that around says it's a lot more costly in terms of dollars if you're trying to buy dollars with rubles. So the ruble has collapsed, and it collapsed almost immediately after this sanction was put in place. There's been a run on the Russian banks. You probably all saw pictures on the news of people lining up to get money out of their accounts. And so there's a very strong likelihood of hyperinflation if the Russian central bank tries to print money. The Russian economy, which wasn't in a very good place to start with, is heading for a recession and very high unemployment. And the thing I spotted this morning as I was reading the Guardian newspaper at 5 o'clock over the breakfast table, as I updated my slides for today, one of the ratings agency has downgraded Russian debt to a CCC rating. They're basically junk bonds. And there's a very, very high risk that there's going to be a default on that debt to add to these other macroeconomic problems that Russia is facing. And then, of course, outside of these financial sanctions, at least until the last couple of days, payments for oil from Russia, payments for natural gas from Russia, payments for fertilizer and other commodities have actually been allowed. But a couple of things are going on. Yesterday, President Biden banned imports of oil from Russia. It doesn't actually supply a huge amount of oil to the US economy. And then the European Union is talking about this. I think Britain has said is phasing out Russian oil imports over the next few months. But there's a lot of self-sanctioning going on as well. Again, I saw another column by Paul Krugman. He had a great link to a shipping website, which said that a lot of oil shipping companies were no longer taking on Russian oil supplies because they were worried about the possibility they would never be able to offload it, because there have been cases, for example, in Britain at an energy plant, I think it was in Wales, South Wales, the trade union there refused to offload a shipload of liquid petroleum natural gas. So I think there's a lot of self-sanctioning going on. And if you add into that McDonald's pulling out of Russia, Coca-Cola pulling out of Russia, Apple pulling, the list is endless of the self-sanctioning that's going on, because major brand names want to protect their brand equity, I think. So now let me talk about the disruption to commodity markets. Ukraine and Russia are key agricultural exporters, and I'll just go through the bullet points on this slide, and then I'll have about 9 graphics to show you very quickly. So here are the numbers. 29%, 18%, 32%, 75% of world wheat, corn, barley, and sunflower oil exports come from Ukraine and Russia. Actually, 50% of sunflower oil comes from the Ukraine. So they are an important supplier of grain and coarse grains to the world market. And I'll give you their absolute share in a minute. Trade out of the Ukrainian Black Sea ports has basically stopped. There is no trade. And even if there was, it probably would be blockaded. The Turkish might blockade it, especially if there were any Russian transportation. Key production locations are under attack. I'll give you a map in a minute of where Wheat is mostly produced in Ukraine. This morning, I saw a report on Reuters that Ukraine itself has banned exports of rye and barley. These are important feed grains. And of course, we're seeing a big price run up, both in wheat, corn, and soybeans in order to ration demand. This is exacerbating pressure on global food security and global food prices. If you think back to Zoe Plakias's talk, again, back in January, she talked a lot about domestic food price inflation, where we're seeing quite worrying global food price inflation, which then feeds into global food security. And this is all happening at a time when we have very low global wheat stocks. I think we're really, the United Nations Food and Agricultural Organization is really worried about the current level of global wheat stocks. Then if we talk, so that's sort of on the production end. If you look at the input end, Russia accounts for 25% of Europe's supply of crop nutrients. And this would be both nitrogen, potash, and phosphate. And so we're seeing significant pressure on fertilizer prices right now, both on the world market and here on imports into the United States. And of course, we're also seeing significant pressure on oil prices, Russia being a major oil exporter, and natural gas prices. And of course, natural gas is an important feedstock into production of nitrogen-based fertilizers. So now I have a whole bunch of graphics just to back up the bullet points. And if you read Farm.News, thank goodness for Farm.News and my friends Gary Schnittke and Scott Owen, former colleagues of ours, of mine and Brent's here at Ohio State University. The first slide I picked up a few days ago, but they have it in today's Farm.Policy News. This is the Ukraine and Russia are called the breadbasket to the world. They're definitely the European breadbasket. They account for 102 million tons of grain going into the world grain market. So you can see they outstrip the United States in aggregate. So they're a very important supplier, and that's for the 2021-22 grain season from the International Grains Council. So a quarter, 25% of global grains trade. Here are, again, this is out of FarmDoc. My old friend, Karl Zuloff, had rewritten a paper that he'd done in 2012 with Gary and others at FarmDoc. They updated their data. You can see the circles for, these are Russian percentage of world exports for Russia and Ukraine. That's the sort of brownie colored columns. If you add up the columns, that's where you get the 30% of world wheat exports are coming out of Russia and the Ukraine. Here's the same slide for corn. So if I do the calculations, we're getting up to what? About 18% of world corn exports coming out of Russia and Ukraine in aggregate. So Ukraine, you can see, it's becoming what? The fourth largest exporter of corn to the world market after the United States, Brazil, and Argentina. Here's that map. Oh, the internet's great. I could have had 10 of these maps for all these commodities, but this is just the key wheat producing regions in Ukraine. And you can see here, this is down the Black Sea. This is where Odessa would be. This is the Azov Sea over here. And then the Financial Times article that I read the other day, they noted this region, this region, this region, this region, and this region here, they're suffering major aerial bombardment and artillery bombardment that's affecting the ability of farmers to plant. Ukrainian farmers would be planting right now until the end of April. And so there's a real chance that even if they were to get it in the ground, we don't know what's going to happen to their ability to harvest, get it to the elevators, truck it to the railroads and to the ports. We don't know what's going to happen to those port facilities. So I think the longer this war goes on, the less likely it seems to me that Ukraine is going to be supplying wheat and other commodities to the global market this coming year. Not surprisingly, there's been a big shock to the wheat futures market, and the wheat futures market hit $13.65 a bushel. That was a couple of days ago. I think it softened a little bit this morning, but already this year they've increased by 77%. That's on the Chicago market. And we're getting somewhere close, as you can see, to the 2008 price spike prices we had back in back in that part of the 2000s. And this is feeding into global food prices. There's real concerns from the UN FAO about global food prices. So this graph pretty much says the same thing as the last one, but this is an index of world food prices. This is where we are going into early 2022. Food prices were already shifting up because of the pandemic, the impact of the pandemic, particularly for wheat. And of course, what happened in Canada last year with hot weather in Alberta, Manitoba, Saskatchewan led to a poor wheat crop in Canada that fed into global wheat prices. You can see this looks awfully like the food price spikes we had back in 2008, 2010. That's around the Arab Spring, and my colleague Mark Bellmare at the University of Minnesota has shown there's a very high correlation between food prices and food insecurity in emerging economies, which also then feeds into political instability. Think Arab Spring. And this kind of is backed up by this graphic here. This is, I really like this graph. I don't know how well it shows up. This is from Al Jazeera. I don't normally quote Al Jazeera, but I found this one online. I do actually do interviews for the Ashart News Network, but not Al Jazeera. But this is a graphic showing grain exports by Russia, that's sort of the blue lines, and Ukraine, those are the sort of reddy lines. And you can see that Egypt is a really major importer of grains from Russia and Ukraine, as is Turkey. But if you run down the list, most of these economies are emerging economies, particularly in North Africa, the Middle East, Africa, and some in parts of Asia. So blocking out those exports from Ukraine and possibly with sanctions against Russia, this is going to feed prices, food prices into these countries that rely on wheat imports. To follow up my point about fertilizer production, this is just data that I found for potash. That's one of the three main nutrients. As you can see, Russia is the second largest potash producer in the world after Canada, but look at the third one, it's Belarus. Belarus, of course, is about the only ally Russia has right now in this war. So we may see that impacting on prices for this particular fertilizer. And then here, again, I think, again, thanks to FarmDoc for this. This was a Bloomberg graph. This is the price per short ton of urea coming into New Orleans. And you can see that, there was, go back to late last year in the US, and then it starts to tail off, but it's starting to spike upwards again. So urea is an ammonium nitrate substitute fertilizer. So that's my picture for what's happening with agricultural commodity markets and the invasion of Ukraine by Russia. So let me then go back to tying this back to China, which was kind of my starting point, and power-based bargaining. So Brent, I hope I haven't tried to bang a square peg too much into a round hole, but I like to think it's worked, but I'll leave that up to the audience. So China has leapfrogged Russia in 2019 to become Ukraine's single largest trading partner. So in 2021, Ukraine exported $18.9 billion worth of products to China. And the key Ukrainian exports to China are iron ore, corn, and sunflower oil. So nearly half of those exports in 2021 were these three commodities, $8 billion worth. So Which two have I already talked about? Corn and sunflower oil. Here's another one. Ukraine accounted for 30% of China's corn imports in 2021. So yes, the United States did very well out of that bilateral trade agreement and with China, if you want to think about it that way, and the fact that China was rebuilding its hog production capacity. But in fact, Ukraine probably just about outstripped the United States in terms of exports of corn last year. And also, Ukraine, and I could have had loads of slides on this, Ukraine has become a really important hub within China's Belt and Road Initiative. Think of that as the new Silk Road. Particularly, and just an example, they've been investing heavily in ports, facilities on the Black Sea. So COFCO, which is a Chinese state-owned enterprise that imports agricultural commodities into China, they've invested $75 million worth into a grain terminal into a Ukrainian port of Mykolaiv. By the way, yesterday I noticed I had the Russian name, not the Ukrainian name, so I changed it to the Ukrainian one today. And then CHC, that's another Chinese firm, that's the Chinese Harbor Engineering Company. They've been dredging the port of Chornomorsk, which is near to Odessa. Again, that's on the western side of the Black Sea. And I also know that COFCO has built COFCO, that's this Chinese grain importing company. They've built a crushing, I'm assuming it's a sunflower seed crushing plant in that port that has been in the news every day, Mariupol, I think that's how you pronounce it. That's where they have an oilseed crushing facility, which presumably is out of use right now because the port is being bombed very heavily. So what about the impact of this commodity market shock on China and then these feedback effects into US agricultural exports and then back to my original hypothesis? Well, how China adapts to the shock clearly has potential to affect US agricultural exports. And I think I've already told the story, but I think China's wheat market is a case in point. So imports by China are controlled under this thing called a TRQ. And a TRQ is made up of a quota. So China has a minimum level of market access for wheat of 9.6 million metric tons. And if anything comes in under that quota, it pays a tariff of just 1%. That's called the in-quota tariff. And anything that comes in over that 9.636 metric million tons pays an over-quota tariff of 65%. And this is all WTO legal. This was negotiated when China joined the WTO. And that's what the US has been pushing China really hard on, how they administer this TRQ. Well, it filled for the first time in 2021. And a lot of this was driven by the increase in the relative price of corn, which led to an increase in the demand for wheat in feed use in 2021. And some of that came from imports. And this is based on a very recent USDA ERS study by my old friend Fred Gale, who is well known for working on the Chinese agricultural sector. So US wheat exports grew very extensively to China in 2021, but so did those of other exporters, including Canada and Australia. And I believe France as well was exporting wheat to China. So even these minimum market access commitments under a WTO legal tariff rate quota are also subject to market volatility. So think of the TRQs as being WTO legal market access import commitments by the Chinese. The US-China trade agreement is just a big version of that, but it's very hard to discipline it because it's not under the WTO. So just to put China's wheat consumption in perspective, China's the biggest wheat consumer in the world, even bigger than the European Union, India, and others combined. So you can see China is a really, really large consumer of wheat. And this graphic here shows you how much imports have come in between 2000 and 2020 under this thing called the tariff rate quota. And you can see that it's fluctuated quite a bit And what you really see is that in 2020, between the United States and other exporters, China's almost hitting that TRQ, but there's a lot of volatility in it. But you can see that blue bar in the last bar, that's that big pickup in US wheat exports in 2020 to China as it started to substitute wheat into its animal feed rations, particularly in the hog production sector. So Brent, here's my last summary slide, square peg, round hole maybe. The US approach, I think, that power-based bargaining has undermined the multilateral system, but the WTO, in my opinion, is currently moribund. And by that, I mean, we've had no negotiations since 1995, no new rules. We've had no trade round. The Doha round failed in 2008. And the appellate board is currently not working. So the WTO, for all intents and purposes, is not an active organization, except for cases that were already being evaluated pre-2019. The United States-China trade agreement did not address the key issue of state-owned enterprises in China and industrial subsidies in China. In other words, the WTO needs to revise its rulebook to address this thing called China Incorporated. The China that joined in 2001 is not the China of 2021 in the way that President Xi Jinping and the Chinese leadership run the Chinese economy. It's become much more, not centrally planned, but much more state-oriented than it was in 2001. And it's focusing much more on being a high-tech exporter than being a low-skilled, intensive exporter. Now, contracting on market access with a country like China is a movement back to this principle of managed trade, which was popular in the 1980s, viz. Japan. Okay, so I said this a few minutes ago. Now, when we look at that TRQ, 90% of that imported wheat is allocated to a Chinese state-owned enterprise, COFCO. So relying on state-owned enterprises in China to meet import targets is just inconsistent with the principle that we want to push China to having market-driven trade, right? We want China to import subject to its tariffs, based on following international multilateral rules of trade based on market-driven processes. So that's kind of a pitch I want to make here, and maybe we can open that up for discussion. So I'm going to argue here that even if we hadn't had the Ukrainian-Russia shock, external shocks to China, internal shocks to China, be they policy-driven, be they hog production capacity-driven or whatever, will continue to make it difficult for US trade negotiators to evaluate the success or otherwise of managed agricultural trade with China. So Brent, that's all I have to say. I know I went on longer than I should have done, but I had a lot more to bring in today than I'd originally planned, let's say 3 weeks ago. So thanks very much, folks, for listening. Really appreciate it.
Well, great. Thanks, Ian. That was fantastic. I learned a lot, and I know a lot of other people did as well. I want to remind people to send questions to either the Q&A or the chat. I have a ton of questions here. I want to follow up on at least one of them here first. I guess what I'm struck by was the price graph you showed, which showed basically, prices, I guess that's in real terms, are roughly where they were in the early 2000s. Well, we didn't really have, we had a really bad recession in 2008, 2009. It had nothing to do with prices of anything, right? It had to do with just bad economic management of a lot of debt, I think. But we didn't really feel the harmful effects of these high prices back then. Are we going to feel harmful effects in the economy now, or are these high prices going to drag us down in any other way? This is a more general question.
I think back in 2008, this was the so-called perfect storm in agricultural commodity markets, where we had weather effects, we had declining yields, or declining rate of growth of yields, particularly in wheat. There hasn't been so much investment in wheat technology. There were, soybeans and corn have maybe kept up, but wheat is a major staple in many of these emerging economies. And of course, also we had the, corn was being sucked into ethanol production here in the United States, and maybe biodiesel in Europe. So the big concern there was not so much about food price inflation here in the United States, but was much more about how food price inflation affected food insecurity in emerging economies. And the problem for a lot of emerging economies is they don't have a food safety net like we do. Now, there are some countries like Mexico and Brazil that have very good food security safety nets. And what happened then was a lot of countries, so in the rice market, for example, India, China, Thailand, Vietnam, they all went in and stopped exporting rice, which then just forced up the rice price even more. And then Russia and Ukraine and a number of other countries who were wheat exporters went into the wheat export market and taxed exports of wheat. And in fact, Russia was taxing exports of wheat during the pandemic, which was one of the reasons why, back here, you saw wheat prices starting to push upwards along with all the other reasons that wheat prices have gone up. Now, what's different this time is not just the Russia-Ukraine shock, but there have been all these shocks during the pandemic. Now, the pandemic hasn't particularly affected agricultural commodity trade per se, but these value chain shocks or blockages in the value chain, particularly domestically, have led to, as we know, both shortages and price increases, not just globally, but domestically. So from a domestic Ohio standpoint, and this is why I mentioned Zoe's talk the other week, is I think this is going to feed back not just into global food prices and global food price inflation, but into US price inflation, food price inflation based on what's, say, happening to wheat prices, but also those input price increases, fertilizers, oil, and others are going to be squeezing farmers from the other end of the farm marketing margin. And so I think, there's potential to hurt farmers here in the United States, depending on the size of those shocks. And then that, of course, feeds into the consumer pocketbook. And so we're getting this additional whammy, if you like, to these two things that are outside the Federal Reserve's core inflation index, which is food and energy, of course, is outside the core price index. But it's tough.
So let me ask you.
It's tough to know what policy instrument there is to deal with that at the moment.
Yeah. So, but okay. So I'm a novice in trade. I just look at the whole world as just sort of the goods and services sloshing all over the place relatively freely, even though there's a few taxes and stuff like out there. But the prices really moderate all this stuff, so that, in fact, actually, it really doesn't matter if we ship 40% of our soybeans or corn or whatever to China, or whether they take it or not, because it's going to go somewhere, because someone's going to buy it at some price. So tell me why that's not true. I mean, why does it matter?
No, I mean, I think, one way of looking at that, let's go back this slide, right? That's just the markets doing their job, right? So I completely agree with you. Is why is the wheat futures price done what it's done? Well, it's signaling that, we're going to have to figure out what we do with existing inventories. What do we plant, or what could be planted to meet demand through the year, right? Is this going to mean that India is going to export more to the world market? Does it mean Australia in the Southern Hemisphere is going to export? So yeah, my point was, Brent, that all the big wheat exporters, Canada, the United States, Australia, France, India, are going to have to adapt to and that's all markets are doing. They're signaling that we need to ration. My point is, going back to China, is if you just focus on bilateral trade with China, right, you're not accounting for all these exogenous shifts in world prices and how world demand and supply is adjusting. That was, you actually understand the point that I was trying to make, I think. Yeah. So yeah, if you don't have frictions like tariffs, and you have minimized transport costs or whatever, markets should do their job, and they've done a pretty good job up to now, I think, of signaling the way things should adapt. Now, that doesn't help you and I as bread consumers, right, you've got to pay a higher price on the supermarket shelf, right? And it really hurts you if you live in Egypt, right? Where bread is a very high portion of the average poor person's diet, as it is in other parts of the Middle East.
Yeah, I mean, I wanted to bring in a question from Alan Lyons, who, as we know, knows a lot about Ukraine, other parts of the world, but actually asked something about China. And his question is China's planning, it seems like, to increase production of a lot of these things, right? A lot of food commodities, basically. I mean, Alan's basically asking, do you think China can do that? Are they going to be able to really shift these markets in the long run, or even in the short run, by increasing production? Do they have the capacity?
No, I don't think so. I mean, everything I understand about just basic theory of comparative advantage would be that China doesn't have the necessary land resources to be anywhere remotely close to being self-sufficient. I don't buy into that argument. But that doesn't mean to say that China is not trying to increase its self-sufficiency, if you want to call it that. And I think China, one reason it's so engaged, or has been so engaged with Ukraine, is it's trying to diversify its import supplies. That's what the Belt and Road Initiative is all about. That's why it's investing in all that infrastructure, both in former Soviet Union, Soviet bloc countries, but also in Africa for other resources. Like, they're building roads and schools in Angola. Why? Because they want to access oil in Angola. So I think this is all part of the broader strategy. Now, I think in the case of soybeans, for example, I did know that the last couple of years, Chinese farmers have been receiving subsidies to plant more food-grade soybeans in China, to try to substitute a little bit. But yeah, they may invest, but I still don't think they can become self-sufficient or close to being self-sufficient. But that doesn't mean to say they can't have an important impact on agricultural commodity markets, one way or the other, right?
Yeah. Well, and so it feeds in, thinking about the latest sort of Ukrainian issue, and this Rivera's question is who's going to be the winner and loser when this all shakes out? I don't pretend to know that we know how things are going to shake out, right? We're still at the beginning of something that's probably going to be a long-term impact on the world and the economy. But, if Ukraine really, so let's actually just say, suppose Ukraine goes down to zero exports of anything, right? Who are the winners and losers from that economically?
Well, obviously Ukraine is a big loser, and clearly Russia, by dint of what's happened on the macroeconomic front, is a big loser. And remember, Russia is what, the 11th largest economy in the world. It's not actually, it's smaller than the economy of Texas, if I understand the figures I've been reading in the Wall Street Journal correctly. So it's not a huge economy, and it wasn't being, as you know, managed particularly well even before this crisis started. So I think, there's a block there, significant block of countries that are going to be hurt very badly by this. I think other big losers are going to be those emerging economies who rely on imports of wheat and grains from from Ukraine and maybe Russia as well.
So consumers in those economies.
So right? Consumers on $1, $1.50, $2 a day, whatever the current World Bank number is for poverty. We're talking about, you and I spend what? How much do we spend? Approximately, less than 5% of my weekly spending goes on food, right? But we're talking about, a huge proportion of consumption goes on food, shelter, and clothing in these countries. And so I think they're potentially very large losers. And that's why the UN is not just worried about high food prices and production. Remember, they're worried, what they look at is the use to stocks ratio, right? And production. They're really worried about you have this big production shock at the same time as we have low stocks, right? Plus everybody else in the Northern Hemisphere who isn't subject to the war itself now has to adapt production to try to take account of what's happening in the wheat and the corn market. So that would be my answer to, to that one is I know who the losers are. I think right now the winners on the wheat side are probably the guys in the Southern Hemisphere. We're talking about Australia, Argentina, and possibly, I guess the Indian subcontinent too. And India, I think, has a lot of wheat in stocks, by the way, that it may be able to shift. And China wasn't importing much from Russia. I think it regarded Russian wheat as being of very low quality, but now it started to looking at contracting even for Russian wheat imports. So, China is, figuring out where the heck it's going to get all this wheat that goes into bread and into animal feed.
Yeah, well, this is super interesting, and we're at our 1 hour time, and I want to be cognizant of your time and the time of our participants here. So I want to thank you in particular for the presentation today. It's super useful, and I just want to reiterate. I think your point is there's lots of losers to what's going on right now, and in addition to Ukrainians, obviously consumers of food, or especially in the poor parts of the world, right? That's a big worry. So. That's good information. So thanks a ton. This is super useful and super interesting. I really enjoyed it. And I really thank everybody for attending today. Thank you, Ian, for giving the presentation. And again, invite folks to come back to our next one in about a month. Mark Partridge will talk about inflation here in the US. And I'm sure he'll probably broaden it out relative to where he was earlier as well. So thanks. I would clap, Ian, if I could. I guess I'll clap.
And anybody who wants to email me with questions, please feel free to do that, because I'm obviously having to pay attention to this right now. It's kind of ruling my life on a daily basis, trying to keep up. So thanks very much for asking me, and I hope this was useful for folks.